So step one, we'll cover that in the last slides. Just note that casualties, once again, your government is on your side. If you net negative, they want to give you the best of all possible worlds, which is an ordinary loss. If you net positive, they're not willing to jump you all the way to capital gains, but they'll characterize you as 1231 gains. So you have the potential of having long-term capital gains if you survive all the rest of the stuff. So we'll look at that, like I said, when we get to the last chapter. So the second step is just to determine from each 1231 property how much your 1231 gain or loss is once you've reduced by your depreciation recaptures, which we're about to do. And then if you put them all together, if you net negative, you're done. You don't need step 3 because a net loss is an ordinary loss. If you net positive, you've got to use that 5-year look-back rule to break the gain into potentially ordinary income and long-term capital gain. And just a reminder about the look-back rule. All right, once you have a net 1231 gain, you have to look back 5 years, and you have to recharacterize as ordinary income to the extent that you have unrecaptured losses, any IOU ordinary incomes because of your ordinary losses in that 5-year period. And if we have any remainder gain, it's long-term capital gain, and you're not done because now you have to go into the capital gain and loss netting pool in order to determine if actually you do have any kind of preferential rates. And all 3 steps apply whether you're an individual or a corporation. Remember, the only thing that a corporation doesn't get is that last step where you get the preferential tax rates on your net capital gains. So that brings us to depreciation recaptures. All right, and we've already talked about this just a little bit. All right, remember, depreciation recaptures do not apply to losses. All we're doing is recapturing gains. 1245 relates to equipment. 1250 is buildings. And then we're going to briefly talk about an additional recapture rule for corporations. I will not test you on it, but I don't want you to go into your corporate class totally unaware that there is more depreciation recaptures for corporations than there are for people. So depreciation recapture 1245 means it's equipment subject to depreciation. We've held it more than a year, so it's a 1231 asset, and 1245 is just a subcategory. All right, applies only to gains. We're talking about those things that were non-commercial or residential real estate. And the potential for ordinary income, so when I say recapture potential, that means the amount of gain that could be recharacterized as ordinary gain is the total depreciation taken. So the ordinary income is recognized to the lesser of this 1245 recapture potential, which is accumulated depreciation, or the realized gain. Your ordinary income will never be larger than your realized gain. Gain not subject to the recapture is a 1231 gain, and you have to go through that netting process before you know what the next step is there. So here's an example. All right, I bought a machine for $120,000. I sold it for $140,000. My accumulated depreciation at the date of sale was $75,000. And makers is just that post-1986 rules that we learned. It really doesn't matter whether it's straight line or accelerated or units of production, because the rule does not take into account the kind of depreciation. It simply says all of the gain to the extent of depreciation taken will be ordinary income. So we've got a couple of steps here, right? You've got to calculate your adjusted basis and your amount realized to get your gain or loss realized. And then you have to recharacterize part of that gain as ordinary income up to the first $75,000 of gain. Any gain in excess of that is a 1231 gain. So our job here is to determine how much is ordinary income, recapture income, ordinary income, 1245 income, they're all the same. And is there any 1231 gain? All right, so we're going. The bottom line is the ordinary income is 75. The 1231 gain is 20. So here's my amount realized. My adjusted basis is 45,000. The cost minus the accumulated depreciation. So it gives me my total gain of 95,000. The first 75 is ordinary income, which leaves me 20 to be a 1231 gain. $12.50 recapture, that's buildings used in a trade or business more than a year. Doesn't matter whether they are commercial or non-commercial. They follow the same rule. All right, all gains, not losses. Never applies if the straight line method is used, and that's because we're using an excess rule. The excess of accumulated depreciation over straight line. And remember that all makers buildings are depreciated only on a straight line basis. So there's not a whole lot of 1250 recap. So we're just going to use my simplified excess rule. The excess of accelerated depreciation over straight line, and I will give you both numbers. You just need to read carefully. You'll have all the information that you need. And remember that maker's property is all straight line, so there'd be no 1250 recapture on a building you placed in service in 1987 or later years. So here's our 1250 example. You purchased rental property, sold it. Here's your accumulated depreciation. Straight line would have been 155,000. And don't let that ACRS confuse you. That was just the rules that were in play right before 1987. And so this is when some accelerated depreciation was available on buildings. What you care about is the excess rule, right? We did not take straight line. We deducted 175,000. And so that's larger than straight line. So there will be some 1250 recapture. So our question is, how much ordinary income is there? And how much 1231 gain do we have? So it's the same job as before, right? Here's our short answer up front. 20,000 of ordinary income and 115 of 1231 gain. To get there, we need our amount realized and our adjusted basis. And that gets us to a gain of 135. The difference between straight line and accelerated was 20,000. So that's why the 20,000 of ordinary income. The remainder of the gain is 12. And then you can see that a recap of this: accelerated depreciation, straight line. So the difference or the excess is 20,000. So the remainder is 1231 gain, because we're talking about a total gain of 135,000, and we're simply breaking it into the two pieces. And this is a good time to talk about that 25% tax rate on the gains from real property. So remember, way back in chapter 10, we said that there was a certain portion of the gains from your selling real property can be taxed at 25% instead of the 15%. And once again, that rate just exists because giving all capital assets a 15% tax rate was just too expensive. And so they left some of the gains from real property behind. The rationale was pretty simple. We're not recapturing any of that straight line depreciation. You got an ordinary deduction for the depreciation, and we're giving you preferential tax rates on the gains that are basically caused by the fact you got an ordinary deduction. And so it's not inappropriate to tax those gains at a higher rate. So let's look at the rules here. Okay, so it does not apply to corporations, right? Corporations have no preferential rates on their capital gains property, so there are no special rates. And the short story here is the amount of your gains relating to depreciation that were not treated as ordinary income. So in our prior example, we had 175 and then we only recaptured 20,000. So the difference would be our unrecaptured net Section 1250 gain. That's the amount that's going to be taxed at the special tax rates. The even shorter version of that is we're talking about straight line depreciation. So the straight line depreciation relating to buildings will be taxed at 25%. So here is accelerated depreciation from the last example, the straight line depreciation, the 1250 recapture, and the 1231 gain. So the 115 to the extent of straight line depreciation will be taxed at the 25% rate. Now, all of this assumes, of course, that the netting process has given us a net 1231 gain. The net 1231 gain has survived the look-back rule, so there actually is a long-term capital gain in play. And we simply will keep our lives really simple here. We will have one piece of real estate that we're selling. We will have no look-back rule. So if I tell you that there's a net 1231 gain from the sale of the property, that is also going to be the long-term capital gain, right? We're going to keep it really simple. So in this particular case, all of the gain that's 1231, that is actually going to be long-term capital gain, is taxed at 25% because the gain is less than the straight line depreciation. Here's a second example. This time we have a building that originally cost $100,000. Depreciation taken was $30,000, and it's all straight line. So there is not going to be any 1250 recapture. So the non-1250 recapture will be all the straight line depreciation. We sold it for $110,000. So the first step is to take our amount realized minus our adjusted basis to get our gain or loss. So our actual adjusted basis is only $70,000 because 100 minus 30. So our full gain is 40. So this time our gain in total is larger than the straight line depreciation that we took. And so the 30,000 will be the 25% tax rate. The remaining gain would be taxed at the 15/0 rate. So a short introduction to the Section 291 additional recapture for corporations applies to buildings, and it's based on all the depreciation to the extent of gain rule, right? That's what 1245 means. All of the gain to the extent of accumulated depreciation. So you can see here the rule is fairly complicated. It's not as strenuous or as the equipment rule because it's not 100% of the gain. It's 20% of what the total depreciation that has not been recaptured through the 1250 rule. All right, so I'll just leave that to digest in your back brain. We will not cover it formally in class. You will not see it again once you go by this slide. But remember that corporations have an additional recapture rule. And please do not go into 410 and tell Dr. Edmonds that you have never heard of 1245 or 1250, because he'll just shake his head at both of us, right? This is information you will be using if you're going into 410. So all of the depreciation recaptures, 1231, capital gains and losses, are all things that you will be discussing from the corporation's perspective. Before we start working through a set of problems, just a review of the characterization of gains and losses relating to 1231. All right, a net 1231 gain or loss. If it's a loss, it's ordinary, end of story. You can go home. If it's a gain, you have to recapture, carve off as ordinary income using your 5-year look-back rule. Any remaining net 1231 gain is a long-term capital gain. And you got to not done because you got to take that to Schedule D, net it with all the other capital gains and losses. And then we have the depreciation recaptures, 1245 and 1250. They create ordinary income before you actually calculate your 1231 gains. Remember, gains only, losses are always 1231 losses. Whether or not they're ultimately ordinary or not would depend upon the netting of the picture of everything else that tax year. 1250 recapture relates to buildings, and it's the excess of accelerated depreciation over straight line. That's how much is ordinary income. 1245 recapture relates to buildings, and that's the all rule, right? Ordinary gain is recognized to the extent of accumulated depreciation. So what we're going to do next is we're simply going to do it all over again. There's 5 pieces of 1231 property here. So for each individual property, we'll calculate the gain, determine if there's any ordinary, determine the 1231, do our netting, and then do our look back. I would strongly suggest that rather than wade through the slides, you go out to part 4 on Blackboard. There is an Excel spreadsheet that has the problems set up for you to work and the full solution. You, by now, most of you are probably totally in control here, and you can very easily do each one, but I would not just read the solutions on the slide. If all you do is do a quick read through the next several slides and you don't do these first, you are not setting yourself up for a good mini test, whatever number's coming up. So do them, check your solutions. If you're queasy, and then come listen to the next part of the slides. But you do want to come back and do the slides at the very end because they are not part of the handout. So the first item was furniture, all right, and there's the information repeated. And so our amount realized minus our adjusted basis gives us our gain or loss. We'll pull off the ordinary portion that relates to recaptures. Any remaining will be 1231 gain or loss. And so here's the answer. It's the same answer that is on the spreadsheet. And so I'm not going to belabor it. If you have any questions about why all the gain is ordinary, remember that there was $5,800 of accelerated depreciation and only $4,000 worth of gain. So all of the $4,000 to the extent of the $5,800 is ordinary income. And then the equipment, here's the facts. Same process, right? And then here's the same answer that you have on the spreadsheet. All right, the total gain was 30. The total depreciation taken was 25. So only 25 of the 30,000 is going to be ordinary, and the other 5 will be a 1231 gain. And here's equipment B. Now equipment B, you actually sold at a loss. Remember, there are no recaptures when you have a 1231 loss. And so all of that 13.5 is a 1231 loss. And here's our building. Remember, building's going to use the excess rule. So if you look at our accelerated depreciation and what straight line would have been, the difference is only 6,000. So that's a maximum amount of the gain that could be treated as ordinary gain. So same process. And here's your answer. The total gain was 37,000. So 6,000 will be ordinary. The rest will be 1231. And our last item is land. Right? Land is not subject to cost recoveries. So there's nothing to recapture. And so all of the gain will be 1231 gain. So $10,000 worth of gain from selling the land. All of the gain is ordinary. I'm sorry, 1231. All right, so now what I'm going to do is I'm going to show the recap of the 1231's ordinary total gain, and then we're going to apply the 5-year look back. So hopefully you did do all this all by yourself on the spreadsheet. You've checked your answer, and so you really don't need this slide, but we'll take it through for those people who might be a little confused still. All right, so our total gains, 1231 gains and losses, were total gains from our 1231 property was 67.5. but our 1231 gain itself was only 32,500 because the rest of it was ordinary because of various depreciation recaptures. So when we are ready to apply the look back rule to determine how much of the 1231 net gain is ordinary versus long-term capital gain, we're only looking at the 32,500. And so here are our history, right? Sometimes I will put last year first, sometimes I'll put the 5th year first. Make sure you know that don't go by the order in which I put them. Actually look at the words attached, right? You want to start at the oldest year back, right? And you want to work your way forward. So you can see here we have various losses and gains. And so now we need to apply the look back rule to determine what our ultimate answer is when we ask how much of the 32,500 is ordinary and how much is a long-term capital gain. All right, so treatment of prior years. 5 years ago, 37.5 was all ordinary, created a 37.5 IOU. We had a gain 4 years ago. All of it was ordinary because it was less than the IOU. And the IOU that's left is simply the difference between the 37.5 and the 22,750. So going into 3 years ago, we still had the potential of ordinary income recapture if we had a net 1231 gain. But life was sad, and we had a net 1231 loss. Ordinary loss automatically, no thinking required. But our IOU bumps up by the whole 18,000. So we now have the potential for ordinary income recapture of 32,750. 2 years ago, we had a gain, ordinary because of the recapture rule, and we whittled our IOU down to 19,250. So last year, we had another gain, ordinary gain, but the IOU is down to 9,250. And now after all that work, we're ready to actually answer the question of how much of this year's net 1231 gains are ordinary and how much are long-term capital gain. So the answer is we pay back the rest of the IOU. So 9,250 is ordinary. The rest is a long-term capital gain. But you're not done, right? Because now that we know how much of a long-term capital gain we have, we need to figure out, are we getting any tax benefit, any preferential tax rate surviving the netting of the capital gains and losses? All right, so there was additional information on the handout just to make life fun, right? We have a short-term capital loss carryover from 2011, and it could have been from anywhere because we know that individuals have an unlimited carry forward of their short-term and long-term net capital losses. And we sold some stock or something on the side, so this year we also generated a $3,000 capital gain. So I have to put the three pieces together in order to determine whether or not we have any income that will be taxed at preferential rates. So this is what we're going to fill out. I've left an extra space on the gains. When there is a net 1231 gain that has survived the look-back rule, you want to pop it into your long-term gain column in order to get to the proper answer. And so you can see here that the 23,250, which was our net 1231 gain that survived with the $3,000, gets us to 26,250 with our short-term capital loss carryover. So we have opposite signs, so we net. So the final answer, please, is that we have $21,250. That is a net long-term capital gain that is subject to preferential tax rates. But if we were a corporation, we would have still done everything up to here, but then we would have just had one ordinary income tax calculation because we don't get any of the benefits of the last step of getting a preferential tax rate. Well, this has been a long journey, 49 minutes so far. I want to close with a reminder that a net 1231 loss is an ordinary loss deductible in full. So here's one last example. We've got our long terms and short terms and a $20,000 net 1231 loss. And so we want to figure out how all of this would impact adjusted gross income if the only other income was wages. So you need to net your gains and losses, capital gains and losses, remembering that a net 1231 loss is an ordinary loss. Right? So you do not have this example in the spreadsheet. So make sure that you finish it, think it through before you look at the last slide. And it is the last slide, so that's good. All right, so here's our facts again. Here's our netting process. We are not including the $20,000 in our netting process because it is a net 1231 loss. Therefore, it's an ordinary loss deductible in full. And that is a true statement whether you are an individual or a corporation. You get to take the $20,000 off the top. So our final answer, please, is going to be the $35,000 minus the 20 plus our net capital gain of $14,000. Note that is a short-term net capital gain, and so we would not get any preferential tax rates despite the fact that we are an individual, because net short-term capital gains are taxed as ordinary income.